Okay, so distinguish between two major types of tax shelter and investment returns. So the you have employer-sponsored plans where you 401k, 403b. There are limitations on the amount you can put in those, but the limitations are much greater. You can put a whole lot more in an employer-sponsored plan than you can in a traditional IRA or a Roth IRA. Um, the but the and again traditional IRA, you have to qualify for the deduction, and there are limits as to the amount you can make depending on your situation and so forth, and deducting. But if the employer-sponsored plans, as long as you're below the limitation that is deducted um, from your taxable income. So, all right. So, difference between an individual requirement account or IRA would be a traditional and a Roth. The traditional IRA contributions are tax deductible. Again, if you qualify, earnings are tax deferred. Taxes aren't paid until the money is withdrawn. Roth, you make the contributions with after-tax money, and the earnings are tax exempt. The three strategies for avoiding overpayment of income. Um, you take advantage of your employer options, your health insurance, flexible spending accounts. There are also transportation reimbursement accounts. Flexible spending accounts can be for both healthcare expenses and childcare. Make the tax sheltered investments. Shift your or tax exempt buying municipal bond. So that is the end of chapter 4.